Welcome to the Finance Wisdom Summaries.
One Up on Wall Street by Peter Lynch. Chapter 1, The Making of a Stock Picker. Peter Lynch debunks the myth of innate investing talent, sharing his humble beginnings as a caddy, where he first heard stock tips. He highlights that studying history and philosophy was more beneficial than statistics for investing, as stock picking is an art, not a science. Lynch introduces the Lynch Law. Whenever he advances, the market declines, illustrating the unpredictability of market movements regardless of personal events. His first stock, Flying Tiger Airlines, was a five-bagger, which funded his graduate school, proving early on the potential of identifying big baggers. He learned the market is difficult to predict, and that small investors tend to be pessimistic and optimistic at the wrong times, leading to self-defeating investment decisions. Lynch's experience managing the Magellan Fund involved significantly increasing the number of stocks held, driven by a constant search for bargains. Key takeaways. Investing is an art, not a science. Don't get bogged down by complex quantitative models. Common sense and a good understanding of logic are more valuable. Pessimism and optimism at the wrong times. Individual investors often get scared out of the market at lows and excited at highs. Patience through market cycles is crucial. Bargains are always available. Even in seemingly unfavorable markets, diligent searching can uncover undervalued companies. Big baggers exist. Finding just a few stocks that appreciate significantly can transform a portfolio. Practical example for daily life. A practical example for daily life is to think about a hobby or local business you're passionate about. For example, if you're a keen gardener and notice a particular local nursery consistently expanding, always having new, healthy plants, and a loyal customer base, consider researching if it's a publicly traded company. Your direct observation gives you an edge that a distant Wall Street analyst wouldn't have. This is similar to Lynch's early observations as a caddy hearing about prosperous companies from club members.
Chapter 2, The Wall Street Oxymorons. Lynch labels professional investing an oxymoron, arguing that average investors can outperform experts due to the inherent disadvantages professionals face. He identifies street lag, where Wall Street analysts and institutions are slow to recognize promising companies, often waiting for others to make the first move or for a company to become widely known. Professionals are often constrained by rules, pre-approved stock lists, and the need to avoid diverse performance to maintain job security, leading to mediocre, safe investments. The pressure from clients and bosses for immediate results often forces fund managers to bury the evidence by selling losing, but potentially good, stocks. Individual investors have numerous advantages, including freedom from restrictions, no need to explain decisions, and the ability to find opportunities locally before Wall Street does. Key takeaways. Don't blindly trust professionals. Their incentives and constraints often lead to herd behavior and delayed reactions. Your amateur's edge is real. Your daily life exposes you to successful businesses before they hit Wall Street's radar. This is a significant advantage. Avoid groupthink. Don't invest just because a stock is popular or recommended by many. Often, by then, the best gains have already been made. Patience is a virtue for amateurs. Without the pressure for quarterly performance, individuals can hold on to promising stocks for the long term. Practical example for daily life. Imagine you frequently visit a local coffee shop that has recently started franchising rapidly, always has long lines, and is expanding its menu successfully. Instead of waiting for a financial news channel to rave about XYZ Coffee Co., use your direct observation. Research if it's publicly traded. Chances are you'll be aware of its success long before institutional investors, who might be restricted by market cap rules or industry classifications, even consider it. This is how you exploit your amateur's edge. Think about a hobby or local business you're passionate about. For example, if you're a keen gardener and notice a particular local nursery consistently expanding, always having new, healthy plants, and a loyal customer base, consider researching if it's a publicly traded company. Your direct observation gives you an edge that a distant Wall Street analyst wouldn't have. This is similar to Lynch's early observations as a caddy hearing about prosperous companies from club members.
Chapter 3. Is this gambling or what? Lynch challenges the conventional wisdom that bonds are always safer than stocks, illustrating with the fable of Manhattan's Purchase, where compounding interest on the initial $24 would have far outstripped the land's value. Historically, stocks have significantly outperformed bonds and treasury bills over the long term. He argues that the risk of investing depends on the skill, dedication, and enterprise of the participant, rather than the asset class itself. Lynch compares investing to a stud poker game, where visible information allows skilled players to assess odds and adjust their bets. Consistent winners in the stock market accept periodic losses and setbacks, confident their method will reward them over time. Key takeaways. Stocks outperform bonds long term. Don't let short-term market fluctuations or a perceived safety of bonds deter you from equity investing. Risk is in the investor, not just the investment. A safe blue-chip stock can be risky if bought at an inflated price, while a risky turnaround can be a conservative bet if well-researched. Embrace uncertainty and losses. Successful investors anticipate and accept that not every stock will be a winner, that market setbacks are part of the game. Use available information. Like cards in stud poker, a company's fundamentals are openly available for analysis to improve your odds. Practical example for daily life. Consider buying a used car. You wouldn't just pick the cheapest one. You'd research its history, check for maintenance records, and perhaps even have a mechanic inspect it. This is analogous to how you should approach stock investing. Simply buying a cheap stock, like a cheap car, without due diligence is a gamble. But with research, your mechanic's inspection, you tilt your odds in your favor, making it an investment, not pure speculation.
Chapter 4. Passing the Mirror Test. Before investing in stocks, Peter Lynch advises answering 3 personal questions. Do you own a house? Do you need the money? Do you have the necessary personal qualities? A house is often the best initial investment due to leverage, tax advantages, and its inherent stability compared to stocks. Never invest money you'll need in the foreseeable future, for example, for college tuition or urgent expenses, as stocks are unpredictable in the short term. Key personal qualities for successful investing include patience, self-reliance, common sense, tolerance for pain, open-mindedness, detachment, persistence, humility, flexibility, a willingness to do independent research, and the ability to ignore general panic. He highlights the human tendency to be concerned when markets are low, preventing buying, and complacent when high, preventing selling, often leading to capitulation at the worst times. Key takeaways. Secure your foundation first. Owning a house and having an emergency fund should precede stock market investments. Invest only what you can afford to lose. This principle ensures that market fluctuations don't force you into bad decisions. Emotional discipline is paramount. Your psychological makeup, especially the ability to counteract natural human tendencies like panic and greed, is more important than raw intelligence. Beware of timing the market based on sentiment. Public optimism often peaks right before a downturn, and pessimism at the bottom. Practical example for daily life. Imagine you're planning a major life event, like a wedding, in 2 years. You have a sum of money saved for it. The mirror test dictates that putting this money into the stock market would be too risky, as you might need it when stocks are down. Instead, it should be in a safer, short-term vehicle like a high-yield savings account or CD, even if the returns are lower. Your personal financial timeline dictates the appropriate investment vehicle.
Chapter 5. Is this a good market? Please don't ask.
Lynch firmly states that predicting the overall stock market's short-term direction is impossible and futile, even for experts. He introduces his cocktail party theory to illustrate market sentiment. The less people want to talk about stocks, or investing with him, an equity fund manager, the closer the market is to a bottom, and vice versa. He emphasizes that successful investing is about finding great companies that are undervalued or underappreciated, regardless of the broader market's performance. Market declines should be viewed as opportunities to buy good companies at bargain prices, not as reasons to sell. The long-term returns from stocks are predictable and superior to bonds, despite short-term volatility. Key takeaways. Ignore market timing. Don't waste time trying to guess the market's next move. Focus on individual company fundamentals. Market volatility is normal. Short-term ups and downs are distractions. A good company's stock price will eventually reflect its earnings. Patience during downturns. Embrace corrections as buying opportunities for quality companies. Focus on the company, not the market. The strength of the underlying business is what drives long-term returns, not macroeconomic predictions. Practical example for daily life. You're at a party and everyone is excitedly discussing their latest stock gains, recommending hot tech companies. According to Lynch's cocktail party theory, this is a red flag. When even the dentist is giving stock tips, it often signals a market top. Conversely, if you mention you're looking into stocks and people quickly change the subject to unrelated topics, it might be a good time to research and potentially buy, as sentiment is likely low.
Chapter 6. Stalking the 10-bagger. Lynch asserts that the best place to find 10-baggers, stocks that appreciate tenfold or more, is close to home, your workplace, local shopping mall, or through everyday observations. He provides examples like Dunkin' Donuts, The Limited, and Pep Boys, where ordinary people could have noticed their success long before Wall Street. Your profession or daily activities can provide an edge. For instance, an auto parts store employee noticing a surge in tire sales, or a doctor seeing the success of a new drug. He cautions against ignoring promising opportunities in your own backyard while chasing exotic or high-tech stocks you don't understand. The key is to leverage your direct experience and observation of successful businesses. Key takeaways. Your unique edge is your greatest asset. What you know from your job, hobbies, or daily consumer habits can lead to discovering profitable companies before professionals. Look for success in mundane places. 10-baggers are often found in seemingly boring or unglamorous industries that Wall Street overlooks. Trust your observations, but follow up with research. Initial observations are just the starting point. Further investigation is crucial. Avoid the grass is greener syndrome. Don't assume better opportunities exist in industries you know nothing about. Practical example for daily life. You consistently notice that a specific brand of healthy pet food called Happy Houd Meals is flying off the shelves at your local pet store, and your friends rave about it. This is your edge. Instead of investing in a complex biotech company you don't understand, research Happy Hound Meals. Is it a publicly traded company? What are its sales like? This direct observation of a successful product gives you an advantage over a distant analyst.
Chapter 7. I've got it, I've got it. What is it? 1. An initial discovery of a company through personal observation or tip is merely a lead and not a buy signal. 2. Thorough research is essential, comparing investing without it to playing stud poker without looking at your cards. 3. Investors often spend more time researching small purchases, like toilet paper, than significant investments, like stocks. 4. It's crucial to understand the impact a successful product has on a company's bottom line, especially for large companies. A hit product might not move the needle for a giant like Procter & Gamble as much as it would for a smaller firm. 5. Lynch introduces his 6 categories of stocks: slow growers, stalwarts, fast growers, cyclicals, asset plays, and turnarounds, emphasizing that understanding a stock's category is the first step in developing its story.
Key takeaways. 1. Research is non-negotiable. Never invest based on a hunch or a tip alone. Due diligence is crucial to avoid costly mistakes. 2. Quantify the impact. For a specific product's success to matter, it needs to significantly affect the company's overall earnings. 3. Size matters for growth. Big companies generally have small stock moves. The biggest gains come from smaller companies. 4. Categorize your stocks. Understanding which of the 6 categories a stock belongs to helps set realistic expectations for its performance and the type of story you need to follow. Practical example for daily life. You notice a new super efficient vacuum cleaner, Clean Sweep 5000, that everyone in your neighborhood is buying and raving about. You learn it's made by a huge conglomerate, Global Industries. Before investing in Global Industries based on this, ask, what percentage of Global Industries' overall sales and profits does Clean Sweep 5000 represent? If it's a tiny fraction, its success, while impressive, might not significantly move the needle for the giant company's stock price, similar to Pampers' effect on Procter & Gamble.
Chapter 8. The Perfect Stock. What a deal! Lynch outlines 13 characteristics of a perfect company, and thus a perfect stock, emphasizing simplicity and dullness. Dull or ridiculous name. Companies like Pep Boys, Manny Mo and Jack, or automatic data processing are often overlooked by Wall Street. Dull or disagreeable business. Industries like can manufacturing, Crown Cork and Seal, coupon processing, Seven Oaks, or hazardous waste, Safety Clean, are often ignored but can be highly profitable. Spin-offs. Divisions spun off from larger companies often have strong balance sheets and motivated new management, leading to lucrative investments. Low institutional ownership and analyst coverage. The less Wall Street knows about a stock, the greater the opportunity for an amateur to discover it before it becomes overpriced. Something depressing. Industries like funeral services, Service Corporation International, are often avoided by investors due to their nature but offer stable niche markets. No growth industry. These industries often lack competition, allowing strong companies to gain market share and thrive. Niche market. Companies with exclusive franchises or strong brand names can raise prices without losing customers. Recurring revenue. Products that customers must continually buy, like razor blades or drugs, are preferable to one-time purchases, like toys. User of technology. Companies that benefit from cheaper technology, like automatic data processing using cheaper computers, are better than tech manufacturers in fierce price wars. Insider buying. When company executives and employees buy shares, it's a strong vote of confidence. Company buying back shares. This action reduces outstanding shares, boosting earnings per share and signaling management's belief in the company's value. Key takeaways. Contrarian thinking. The most attractive investments are often the ones that are boring, unglamorous, or even depressing to Wall Street. Simplicity and understandability. Invest in businesses you can easily understand. Any idiot could run this joint is a positive sign. Hidden gems. Spin-offs, companies with low analyst coverage, or those in overlooked industries are prime hunting grounds for undervalued opportunities. Alignment of interests. Strong insider ownership and share buybacks signal that management's interests are aligned with shareholders. Practical example for daily life. You hear about a company called Municipal Sewer and Drain that specializes in cleaning municipal sewer systems. It's a boring name, a disagreeable business, and probably has low institutional ownership. However, you notice that they've been consistently winning contracts in your growing city and expanding into neighboring towns. This fits several perfect stock criteria: dull, disagreeable, in a no-growth industry with local niche opportunities. This is the kind of company Peter Lynch would encourage you to research further, ignoring the sizzle of more exciting but riskier ventures. Chapter 9. Stocks I'd Avoid.
Lynch advises avoiding the hottest stock in the hottest industry, as these are often based on hope and thin air, leading to rapid rises and equally rapid crashes. He highlights how high-growth, hot industries attract excessive competition, leading to price wars and ultimately eroding profits for most participants. Beware of companies touted as the next IBM or the next McDonald's, as imitators rarely achieve the same success as the original. Diversifications are a common mistake made by profitable companies, often leading to overpaying for acquisitions and mismanagement to the detriment of shareholders. Avoid whisper stocks or long shots, companies with exciting but unsubstantiated stories, often lacking earnings or a clear path to profitability. Beware of companies that are overly dependent on a single customer or supplier, as this creates a precarious situation. A flashy or exciting company name can be a red flag, as it might attract investors based on sizzle rather than substance. Key takeaways: flee the hype. Hot industries and popular stocks are often overvalued and prone to significant declines. Don't chase trends. Competition kills. Industries with low barriers to entry and intense competition rarely sustain high profits. Focus on the original proven success. Imitators rarely replicate the original's triumph. Stick to core competencies. Companies that stray from their main business through unrelated acquisitions, diversifications, often destroy shareholder value. Substance over sizzle. Practical example for daily life. Your friend is raving about a new company, Quantum II Dynamics, which claims to have a revolutionary artificial intelligence solution that will change the world. They are touting it as the next Google. Your friend bought shares on hype alone. This is a classic hot stock in a hot industry with an exciting name and whisper stock characteristics. Lynch's advice would be to avoid it until it has a proven track record, substantial earnings, and a clearer business model, rather than falling for the futuristic promise.
Chapter 10. Earnings, Earnings, Earnings. Lynch emphasizes that a company's value and its stock price over time always boils down to its earnings and assets. He illustrates the importance of earnings by comparing investment choices to personal financial assessments, categorizing individuals as slow growers, stalwarts, cyclicals, asset plays, and fast growers based on their income patterns. Stock price and earnings per share generally move in tandem. If the stock price deviates significantly from the earnings line, it tends to revert. The price per earnings ratio, PE ratio, is a crucial metric. A fairly priced company's PE ratio should roughly equal its earnings growth rate. A PE half the growth rate is attractive, while twice the growth rate is a red flag. Excessively high PE ratios are a significant handicap, as companies cannot live up to unrealistic expectations. Companies increase earnings in 5 basic ways: reducing costs, raising prices, expanding into new markets, selling more in old markets, or disposing of losing operations. Key takeaways: earnings drive value. Ultimately, a company's ability to generate profits is the primary determinant of its stock price. PE ratio as a valuation tool. Use the PE ratio in relation to the company's earnings growth rate to assess whether a stock is reasonably priced. Avoid overpriced stocks. A high PE indicates inflated expectations that even a great company often cannot meet, leading to stock price corrections. Understand the growth drivers. Investigate how a company plans to increase its earnings and monitor if those plans are working. Practical example for daily life. You're looking at 2 local restaurants for investment. Diner A has steadily growing profits and its PE ratio is 10, while its earnings are growing at 10% per year. Diner B is a hot new spot. Its stock is soaring and it has a PE ratio of 50, but its earnings are only growing at 15%. Based on Lynch's PE rule, Diner A is a much more attractive investment because its PE matches its growth rate. 10 PE equals 10% growth. Diner B is significantly overpriced relative to its growth, making it a risky bet, much like McDonald's at a PE ratio of 50 in 1972. Chapter 11. The 2-minute drill. Before buying a stock, you should be able to articulate a 2-minute monologue explaining why you're interested in it, what needs to happen for the company to succeed, and the potential pitfalls. This monologue helps you understand the company's story based on its category, slow grower, cyclical, etc. For slow growers, the story centers on dividends and their sustainability. For cyclicals, it's about business conditions, inventories, and pricing. For asset plays, the focus is on the value of hidden assets. For turnarounds, the story is about the company's recovery plan and its progress. For stalwarts, key elements are the PE, recent price run-up, and any catalysts for accelerated growth. For fast growers, the story is about how and where the company can sustain rapid expansion. Lynch illustrates the importance of this drill with his successful investment in La Quinta Motor Inns and his costly mistake with Bildner's, where he failed to ask a critical question about replicability. Key takeaways. 1. Clarity of investment thesis. If you can't explain your investment to a child in 2 minutes, you don't understand it well enough. 2. Know the story. Every stock has a fundamental story that dictates its potential and risks. Understanding this story is crucial for monitoring the investment. 3. Replicability is key for fast growers. For companies planning expansion, ensure their successful model can be duplicated in new markets. 4. Don't fall for euphoria. Even with a good initial idea, don't overlook crucial questions or warning signs, as Lynch did with Bildner's. Practical example for daily life. You're considering investing in a local fast casual restaurant chain called Fresh Wraps, which is wildly popular in your city. Your 2-minute drill should sound something like this. Fresh Wraps is a fast grower. They have a successful prototype here in our city with consistent crowds and good profit margins. Their plan is to open 5 new locations in neighboring cities this year. I need to check their debt, ensure they have capital for expansion without diluting shares, and see if those first few new locations prove as successful as the original. The pitfall would be if their concept doesn't translate well to new markets, like Bildner's, or if competition intensifies rapidly. Chapter 12, Getting the Facts. Lynch emphasizes that all pertinent information for individual investors is readily available, often from public sources like annual reports, quarterly reports, and industry publications. He advises utilizing full-service brokers as information gatherers, requesting S&T reports, value line surveys, and the firm's analyst reports. Calling the company's investor relations department is a valuable, underutilized resource for amateurs to ask specific questions about the company's plans, earnings, and operations. Quote, kicking the tires. Visiting stores, trying products, and observing customer behavior is a fundamental research strategy that provides first-hand insights not available in reports. He teaches how to quickly glean essential financial information from annual reports, focusing on the cheaper paper sections, the consolidated balance sheet for cash and debt, and the 10-year financial summary for share buybacks. Lynch notes the tendency of companies in immature, hot industries to use overly optimistic language, while those in mature industries might sound unenthusiastic even when doing well. Investors should ignore adjectives and focus on numbers. Most important or impactful lessons. Information abundance. Don't rely on rumors. The facts you need are publicly accessible. Utilize your broker as a resource. Make your broker work for their commission by providing you with research materials. Direct company contact. Investor relations departments are there to answer shareholder questions. Prepare thoughtful questions to get meaningful answers. Hands-on research. Personal experience with a company's products or services and observing its operations provides invaluable insights not found in financial statements. Read between the lines or ignore the lines. Filter out corporate jargon and optimistic spin. Focus on objective financial data. Practical example for daily life.
You're interested in a regional supermarket chain, Fresh Foods, Inc. Instead of just buying the stock because you like shopping there, you ask your broker for the latest S&P report and any analyst coverage. Call Fresh Foods' Investor Relations Department and ask about their plans for new store openings, recent cost-cutting initiatives, and how rising food prices might impact their profit margins. Visit several Fresh Food stores in different neighborhoods to observe customer traffic, cleanliness, and product freshness, kicking the tires. Request their annual report and quickly check their cash position versus debt, and if they're buying back shares. This comprehensive approach, combining public data with your own grassroots research, gives you a well-rounded understanding of the company.
Chapter 13. Some famous numbers. Percent of sales. Understand how much a specific product contributes to a company's total sales and earnings. A hit product might not significantly impact a large company. P/E ratio refinement. A company is fairly priced if its P/E ratio equals its earnings growth rate. A P/E of half the growth rate is a bargain. Double the growth rate is overvalued. Cash position. Companies with significant cash reserves, net of debt, are financially strong and less likely to go bankrupt. This cash can act as a floor for the stock price. Debt factor. Analyze the debt-to-equity ratio. High debt, especially bank debt, due on demand, is a major red flag, increasing bankruptcy risk. Funded debt, long-term bonds, is less risky. Pension plans. Check if pension plan assets exceed vested benefit liabilities. A deficit can be a major financial burden. Key takeaways. Numbers tell a story. Financial metrics, when understood in context, provide critical insights into a company's health and prospects. Debt is the enemy. Excessive or risky debt is the most common reason companies fail. Prioritize companies with strong balance sheets. Beyond the surface. Don't just look at headline numbers. Dig into cash and debt details and understand what constitutes real book value and hidden assets. Free cash flow is king. Companies that consistently generate more cash than they need for operations are financially robust and often excellent investments. Practical example for daily life. You're looking at a small manufacturing company, Widgets Inc. You learn it has a P/E of 8 and earnings growth of 15%. This is a positive sign. 15% divided by 8 equals 1.875, which is over Lynch's 1.5 is okay rule. You also check its balance sheet and see it has substantial cash and low debt, which is great. However, you notice its inventory has grown 30%, while sales only grew 5%. This is a red flag, indicating potential future problems. This detailed analysis of key numbers helps you make an informed decision beyond just a superficial glance. Chapter 14. Rechecking the story. Regularly reevaluate the company's story every few months to see if the underlying thesis for your investment is still valid or if new cards have turned over. Growth companies typically go through 3 phases: startup, riskiest; rapid expansion, safest and most profitable; and mature or saturation, most problematic as growth slows. It's crucial to identify when a fast-growing company is approaching market saturation, as this signals a slowdown in their primary growth engine. Successful companies like McDonald's find new ways to grow even after initial market saturation, such as drive-thrus, breakfast menus, and international expansion. Lynch's experience with Texas Air, Continental Air, illustrates the danger of complacency and ignoring negative fundamental shifts even when a stock has performed well. A critical lesson from his Texas Air mistake was not using the deteriorating fundamentals to invest in a competitor, Delta Airlines, that would benefit from the situation. Key takeaways. Dynamic monitoring. Investing isn't a one-time decision. Companies and their industries are constantly evolving, requiring continuous monitoring of their story. Anticipate saturation. For fast growers, recognize when their primary expansion phase is nearing its end and evaluate their new growth strategies. Avoid complacency. Success can breed overconfidence. Continually question your investment thesis, even for winning stocks. Benefit from others' problems. A competitor's struggles can present a significant opportunity for well-positioned rivals. Practical example for daily life. You've invested in a fast-growing regional gym chain called FitFast because they were rapidly opening new, popular locations. Regularly recheck the story. Are they still opening new gyms at the same pace? Are the new gyms as popular as the old ones? Is the market becoming saturated in your region? If you notice new gym openings slowing and existing gyms looking less crowded, you might need to reevaluate your investment. This is similar to how Lynch monitored the Limited and McDonald's expansion.
Chapter 15, the final checklist. This chapter provides a concise summary of all key factors to consider for each of the 6 stock categories: slow growers, stalwarts, cyclicals, fast growers, turnarounds, and asset plays, as well as general considerations for all stocks. General stock points: PE ratio relative to industry, low institutional ownership, insider buying, consistent earnings growth, except for asset plays, strong balance sheet, low debt, high cash, and cash per share. Slow growers: focus on consistent high dividends and a low payout ratio. Stalwarts: key is price, PE, avoiding diversifications, checking long-term growth and recession performance. Cyclicals: monitor inventories, supply and demand, new competitors, and anticipate PE shrinkage as business recovers. Fast growers: ensure the product is significant to the company. The growth rate is realistic, 20 to 25% ideal. The concept is replicable, and there's still room to grow. Low institutional ownership is a big plus. Turnarounds: crucially, assess survivability, cash, debt structure, the disposition of unprofitable divisions, and signs of business recovery. Asset plays: determine the true value of assets, hidden or otherwise, and the debt subtracting from them. Look for potential raters. Key takeaways: structured research: use a checklist approach to ensure all vital aspects of a company are considered before investing. Tailor research to category: different types of stocks require different analytical focuses. Holistic view: combine qualitative, story, management, and quantitative, numbers, factors. When in doubt, tune in later. If the company story is unclear or there are too many red flags, it's better to wait. Practical example for daily life. You're looking at a small, publicly traded regional airline called Fly Low Airlines as a potential turnaround. Using the checklist, you'd specifically ask, does Fly Low have enough cash to survive? How much debt do they have, and is it mostly long-term or short-term bank debt? Have they sold off any unprofitable routes or aircraft? Are their passenger numbers, business picking up, actually increasing, not just projected to? This focused approach for a turnaround candidate helps you identify critical survival factors.
Chapter 16, Designing a Portfolio. Lynch sets realistic long-term expectations for stock returns, 12 to 15% compounded annually after costs, reminding investors that consistent 25 to 30% returns are unrealistic. He advises against frequent trading due to commissions and transaction costs, which erode returns. 1. The ideal number of stocks in a portfolio is not fixed, but rather determined by the number of companies where you have an edge and have uncovered an exciting prospect that passes your research tests. For small portfolios, owning between 3 and 10 stocks is comfortable. Diversification across different stock categories, growth, stalwarts, cyclicals, turnarounds, and asset plays can help minimize downside risk, provided each stock is a knowledgeable purchase. He famously advises against watering the weeds and pulling out the flowers, meaning don't sell your winners and hold on to your losers if the fundamentals don't support it. Instead, rotate out of stocks where the fundamentals have deteriorated or the price has significantly outrun the story and into better opportunities. He strongly criticizes stop orders, which are automatic selling at a predetermined loss, because they guarantee losses due to market volatility and often result in selling right before a rebound. Key takeaways: realistic expectations. Manage your expectations for returns to avoid frustration and impulsive decisions. Minimize trading costs. Frequent trading erodes profits. Hold quality stocks for the long term. Quality over quantity. Focus on thorough research for a few companies you truly understand, rather than diversifying into unknown territories. Sell the deteriorating story, not just the declining price. Your selling decisions should be based on a change in a company's fundamentals, not just stock price movements. Embrace volatility for buying. Price drops in good stocks are opportunities to buy more, not reasons to sell. Avoid stop orders. Practical example for daily life. You own 3 stocks: Tech Gadgets Co., a fast grower, Utility Power Inc., a slow grower, and Steel Mill Rebound, a turnaround. Tech Gadgets has soared, and its story is still strong. Utility Power has barely moved, and its dividend is stable. Steel Mill Rebound has dropped, but the company's turnaround plan is progressing well. Lynch would suggest hold Tech Gadgets, hold Utility Power unless its fundamentals deteriorate. Consider buying more Steel Mill Rebound as its story is improving despite the price drop. Do not set a stop order on Steel Mill Rebound that would force you to sell it at a loss, as it might rebound just after.
Chapter 17. The best time to buy and sell. The best time to buy stocks is when you've found solid merchandise at a good price, regardless of the overall market. 2 periods offer great bargains: year-end tax selling, when investors dump losers for tax benefits, and market collapses or corrections. Lynch recounts how the 1987 market crash presented opportunities to buy quality companies like Walmart, Dreyfus, and Home Depot at bargain prices. When to sell? Never sell solely based on external economic conditions unless you're sure of a specific impact, example, falling dollar hurting foreign automakers. The primary reason to sell is that the company's fundamental story has deteriorated or a better investment opportunity exists. Selling slow growers. When fundamentals deteriorate, market share is lost, no new products, diversifications occur, balance sheet weakens, or dividend yield becomes unattractive. Selling stalwarts. When the stock price outruns the earnings/PE, diversifications appear, growth slows, or insider buying ceases. Selling cyclicals. Best to sell towards the end of the cycle when inventories build up, commodity prices fall, or new competition arises. Selling fast growers. When the rapid growth phase ends, market saturation is near, sales disappoint, or institutional ownership and hype become excessive. Selling turnarounds. When the turnaround is complete and the company has returned to health, reclassify it, and if it no longer fits your turnaround focus, sell. Selling asset plays. Often best to wait for a corporate raider or a leveraged buyout to realize the asset's full value. Sell if management issues new shares or takes on debt, diluting asset value. Beware the drumbeat effect from media and experts, which can lead to selling good stocks due to irrational fear. Key takeaways. Buy during panics. Market downturns are your best friends as they create incredible buying opportunities. Selling is about the story, not the price. Your exit strategy should be tied to changes in the company's fundamentals and story, not arbitrary price targets or market noise. Avoid the "congratulations, don't be greedy." Don't let brokers or others talk you into selling winners prematurely if the company's story is still strong. Be skeptical of media drumbeats. Mass media and expert consensus often lead to ill-timed decisions. Practical example for daily life. You own stock in Innovative Robotics Corp., a fast grower. You've noticed their sales are slowing, and their latest product launch didn't get as much traction as expected. Additionally, several news articles highlight Innovative Robotics as the darling of Wall Street, with institutions now owning 70% of its shares. This signals that the rapid growth phase might be ending and the stock is likely overhyped. According to Lynch, this is the time to consider selling, even if the price is still high, because the underlying story is deteriorating and everyone is already aware of its success.
Chapter 18. The 12 silliest and most dangerous things people say about stock prices. If it's gone down this much already, it can't go much lower. False. Stocks can go to zero. Lynch's experience with Kaiser Industries taught him this lesson. You can always tell when a stock's hit bottom. False. Trying to catch a falling knife is dangerous. Wait for the stock to stabilize. If it's gone this high already, how can it possibly go higher? False. Great companies can continue to grow and appreciate significantly. Don't cap your winners. It's only $3 a share, what can I lose? False. You can lose 100% of your investment regardless of the per-share price. The total investment matters. Eventually, they always come back. False. Many companies, even once famous ones, never recover from decline or bankruptcy. It's always darkest before the dawn. Sometimes it's darkest before pitch black. Don't assume a bad situation can't get worse. When it rebounds to $10, I'll sell. False. This arbitrary target often leads to holding on to a losing stock longer than necessary or selling just before it genuinely recovers. What me worry, conservative stocks don't fluctuate much. False. Even traditionally safe stocks, like utilities, can be volatile and risky due to changing industry dynamics. It's taking too long for anything to ever happen. Patience is key. Good companies often sleep for years before a major move. Look at all the money I've lost. I didn't buy it. False. Not owning a successful stock doesn't mean you lost money. This mindset leads to FOMO, or fear of missing out, and bad decisions. I missed that one, I'll catch the next one. False. The next big thing rarely performs as well as the original. Stick to proven successes. The stock's gone up, so I must be right. Or the stock's gone down, so I must be wrong. False. Price movements in the short term don't validate or invalidate your investment thesis. Focus on fundamentals. Key takeaways. Challenge conventional wisdom. Many commonly held beliefs about stock prices are dangerous myths. Avoid emotional biases. Don't let fear, hope, or arbitrary price targets dictate your investment decisions. Focus on the business, not the stock price. The value of your investment is tied to the company's underlying health and prospects, not its short-term market fluctuations. Patience and humility. Recognize that great results take time and that you won't always be right, but adhering to sound principles will yield long-term success. Practical example for daily life. Your friend bought a stock at $50, it dropped to $10, and they say, it can't go any lower. This is a classic trap. Instead, you'd apply Lynch's wisdom, a stock can always go to zero. Or your friend buys the next big social media app because they missed investing in Facebook early. You would remind them that the next one rarely succeeds as well as the original, and to focus on proven businesses.
Chapter 19. Options, Futures, and Shorts. Lynch strongly advises against individual investors engaging in options, futures, and shorting stocks, calling them side bets that are nearly impossible for amateurs to win. He highlights that 80 to 95% of amateur players lose money in options and futures, worse odds than in a casino. Options are expensive, buying time, commissions, and expire worthless, leading to 100% losses repeatedly. Futures and options do not contribute to capital formation or the growth of companies. They are a zero-sum game, where one person's gain is another's loss. Portfolio insurance strategies using futures and options contributed to market declines by triggering automatic selling. Shorting stocks, while potentially profitable if a stock declines, is extremely risky because there's no limit to how high a stock price can go, leading to potentially infinite losses. Successful shorting requires immense patience, courage, and resources to withstand potential rallies against your position. Key takeaways. Avoid speculative instruments. Options, futures, and short selling are highly speculative and designed for professional traders, not individual investors. Focus on investing, not gambling. True investing involves owning a piece of a business that grows. These instruments are pure bets on price movements. Risk of infinite loss, shorting. Understand that while long positions can only lose 100% of your investment, short positions have unlimited downside. Capital preservation. Protect your capital by sticking to understandable, fundamental-based investments rather than complex, high-risk strategies. Practical example for daily life. Your friend is excited about buying call options on a hot tech stock, believing it will skyrocket in the next month. They explain how a small investment could lead to huge gains due to leverage.
Lynch would advise you to avoid this, likening it to buying a lottery ticket. While the potential gain is enticing, the probability of the option expiring worthless is very high, resulting in a complete loss of your investment. Instead, he would encourage you to buy the actual stock if you believe in the company, allowing you to benefit from its long-term growth, even if it's slower.
Chapter 20. 50,000 Frenchmen Can Be Wrong. Lynch recounts numerous major historical events: Cuban Missile Crisis, Nixon's resignation, OPEC oil embargo, and notes that the stock market's short-term reaction was often illogical or counterintuitive to the significance of the event. He emphasizes that gradual trends and long-term changes, like the rise of conglomerates or the Japanese market, are far more impactful than daily news cycles. The increased volume of trading, driven by institutional investors and technology, creates more volatility but doesn't change the fundamental value of companies. He criticizes the rent-a-stock market mentality, where professionals churn stocks for short-term gains, contrasting this with the prudent and stabilizing role of individual long-term investors. Lynch expresses continued optimism about America's economic future, its entrepreneurial spirit, and its ability to adapt, despite common worries about deficits, job losses, or social problems. He reiterates that stock market declines are opportunities, not disasters, for the patient investor. Key takeaways: ignore the noise. Daily news, political events, and economic forecasts rarely provide useful insights for long-term investing. Focus on the slow, fundamental changes in companies. Long-term trends matter. Pay attention to sustained industry shifts and company transformations over years, not days. Be a stabilizing force. As institutional investors become more flighty, individual long-term investors can capitalize on their short-term mistakes. Fundamental faith in progress. A basic belief in capitalism and human ingenuity is essential for successful long-term investing. Market declines are gifts. View periods of panic as chances to acquire excellent companies at discounted prices. Practical example for daily life. The news is filled with dire warnings about a potential trade war impacting global supply chains. Financial commentators are predicting a market crash. Instead of panicking and selling your well-researched stocks, you recall Lynch's advice. Short-term news often has an illogical market reaction, and experts are often wrong. You focus on your specific companies. Is their long-term story still intact? Are their earnings still growing? If so, a market dip might just be an opportunity to buy more of your favorite companies rather than a signal to flee.
Main idea of the book. One Up on Wall Street by Peter Lynch champions the average investor, asserting that their everyday observations and common sense can outperform Wall Street professionals. Lynch, famed manager of the Magellan Fund, demystifies stock picking by encouraging individual investors to leverage their existing knowledge from daily life, be it from shopping, work, or hobbies, to identify promising companies. He emphasizes diligent research into a company's fundamentals like earnings and debt, rather than relying on market predictions or hot tips. The core message is that patience, self-reliance, and a focus on understanding the underlying business are the true keys to achieving substantial long-term returns in the stock market.
If you enjoyed the content, please consider supporting the author.
Thanks for watching, and if you like this video, subscribe. Now, let's go to the next video.